Normally, physical retail is just this story of doom, gloom, and empty parking lots.
Right, totally.
I mean, you hear the phrase retail space, and you immediately picture like a dying 1990s shopping mall, or an abandoned big box store, or maybe just a sea of cracked asphalt waiting to be redeveloped into apartments.
Yeah, the classic retail apocalypse narrative.
Exactly. But right now, in the middle of 2026, there is a company quietly spending nearly $400 million in just 90 days to buy up what might be the most mundane, invisible real estate in America.
Mundane is definitely the right word for it.
We are talking about unanchored strip malls.
Yeah.
No grocery store, no movie theater, just a concrete box on a busy road.
Huh.
So today we're tearing into Curbline Properties, ticker symbol CURB, and their second quarter 2026 earnings call.
It's a fascinating one.
It really is. We've gone through the transcript, the supplemental financials, and the management commentary to give you a clear, data-forward, and actionable perspective on whether this stock is a buy, hold, or sell. Okay, let's unpack this.
Let's do it.
We're looking at a REIT, a real estate investment trust that was recently spun off from Site Centers, and they have effectively decided to ignore every conventional rule of modern retail development.
They really have. I mean, they've completely abandoned the traditional playbook here.
How so?
Well, for the last 2 decades, the consensus in commercial real estate was that if you wanted to survive the rise of e-commerce, you had to build a lifestyle center.
Right, like an outdoor mall.
Exactly. You needed to create an experience. Fire pits, luxury seating, boutique coffee, high-end fitness centers. The entire architecture was designed to maximize dwell time.
So keeping people there all day.
Right. The theory was that if you keep the consumer on the property for 3 hours, they will inevitably spend more money. But Curbline is playing an entirely different game.
Yeah, they really are.
Their entire focus is unanchored, convenience-based retail on primary vehicular corridors. And their CEO, David Lukes, actually noted that the average customer spends less than 7 minutes at a Curbline property.
7 minutes? I mean, that's entirely transactional. You pull off the main road, park 10 feet from the door, drop off a package at FedEx, grab a smoothie, and leave. You aren't lingering at all.
No, it is errand-based, frictionless real estate. And from an investment standpoint, the beauty of this model lies in its resilience.
Because it's stuff you have to do in person.
Precisely. An unanchored strip mall relies heavily on service-oriented tenants, medical retail, local dentistry, quick service food, logistics drop-offs. These are basically utilities.
Right. You can't get a tooth pulled on Amazon.
Exactly. You might cancel a shopping trip to a luxury mall during a macroeconomic downturn, sure, but you still need your teeth cleaned and you still need to pick up a prescription.
Makes sense.
But to really evaluate if Curbline is executing on this premise, we have to look closely at the Q2 financials. Because on the surface, there is a lot of accounting noise that could easily mislead a retail investor looking at a standard stock screener.
Yeah, let's get right into the top line profit metrics, because this is where the GAAP accounting rules really distort the reality of real estate operations.
They really do.
In Q2, Curbline reported operating funds from operations, or OFFO, of $33.3 million.
Which is a solid number.
Yeah, that comes out to 31 cents per diluted share, which is a very solid jump from the $26.9 million they reported in the same quarter last year.
Right.
But, and here's the catch, if you look at their net income, it's sitting at just $6.9 million, or woro 6 cents per share.
It looks terrible on paper.
A casual investor might see that massive gap, $33 million versus $6.9 million, and think the company is bleeding cash through operational inefficiencies, right?
Oh, absolutely.
But looking at the supplemental, that net income number is being heavily weighed down by depreciation schedules that don't reflect the actual physical reality of these assets.
Yeah, the reliance on traditional net income is one of the biggest pitfalls for generalist investors looking at REITs.
Break that down for us.
Sure. So, under standard accounting principles, a company must depreciate the value of its physical assets over time. If you run a logistics company and you buy a fleet of delivery trucks, those trucks legitimately lose value every year.
Right. They break down.
They rust, the engines degrade, and eventually they are sold for scrap. So the depreciation expense on the income statement matches the physical reality of the asset.
Makes sense for trucks.
But commercial real estate operates differently. A well-maintained strip mall in a high-traffic, high-income demographic corridor does not lose value over a 30-year useful life.
No, the land becomes more valuable.
Exactly. Historically, the land and the structure appreciate.
Yet the accounting rules still force Curbline to take massive non-cash depreciation charges against their earnings every single quarter.
Which is why the real estate industry relies on funds from operations, basically adding that phantom depreciation expense back into the equation.
Right.
And Curbline goes a step further by focusing on operating FFO, which strips out even more one-time items, transaction costs, and accounting anomalies to give you a pure view of the recurring cash generated by the properties.
So that $33.3 million OFFO figure is the real pulse of the business.
It is. The cash flow is growing, and it is growing primarily because of the sheer velocity of their acquisition engine.
Let's talk about that engine, because the scale of their capital deployment is staggering for this specific asset class.
It really is.
They acquired $374.1 million worth of properties in the second quarter alone.
Just in one quarter.
Yeah. That brings their year-to-date total to $563.7 million.
And just to contextualize this for you, when Curbline was first spun out as a standalone public company, the initial expectation they communicated to the market was roughly $500 million in acquisitions for their entire first year.
Right.
They have blown past their 12-month target in 6 months.
It's incredible. And the velocity of deployment is a direct reflection of the fragmentation of this market.
What do you mean by fragmentation?
Well, there is no institutional database of unanchored strip malls. They aren't historically traded in massive billion-dollar portfolio deals orchestrated by Wall Street investment banks.
They're just scattered everywhere.
Exactly. Curbline is out there aggregating these assets one by one, which requires a massive logistical effort. And we need to look at what happens to those assets once they are acquired. Because while the top-line acquisition numbers are phenomenal, there's a metric in the earnings report that could raise a massive red flag if we don't properly dissect it.
Ah, the same property NOI.
Yes, same property net operating income.
Okay.
The income generated from the properties they have owned for at least a year dropped 0.5% in the second quarter.
Yep, it went negative.
So wait, income dropped 0.5%,
Yeah.
but they're buying properties like crazy. Is this a red flag for the listener holding this stock? Normally, if a REIT is aggressively buying top-line revenue through acquisitions while their core existing portfolio is shrinking, it implies they are masking fundamental weakness.
That's a standard fear, yeah.
A shrinking same-property NOI usually means tenants are defaulting, rents are falling, or operating expenses are spiraling out of control.
But if we connect this to the bigger picture,
Okay, let's hear it.
digging into CFO Connor Fennerty's commentary, that negative 0.5% seems entirely driven by two isolated anomalies rather than a systemic failure.
Okay, good.
It is a vital distinction to make. Net operating income is the lifeblood of real estate valuation. It is the gross rental revenue minus the day-to-day operating expenses of the property.
Right.
But the quarterly reporting of NOI can be heavily distorted by the mechanics of commercial leases. Fennerty pointed out a 260 basis point headwind caused by the timing of recovery revenues.
Break down recovery revenues for us.
Sure. In commercial real estate, especially in unanchored retail, leases are typically structured on a triple net basis.
NNN.
Exactly. The tenant pays a base rent for the space, but they are also contractually obligated to pay their pro rata share of the property's operating expenses, specifically property taxes, insurance, and common area maintenance.
Yeah, I noticed looking at the supplemental financials that a massive chunk of that drop isn't actually lost business. It's just a timing mismatch on those recoveries, right?
That's exactly it.
The tenants still owe the money, but the accounting recognition of that revenue doesn't perfectly align with the calendar quarter.
Right. The timing mismatch occurs because things like property taxes are often assessed and billed in arrears by local municipalities, and common area maintenance budgets are reconciled annually.
Those lumpy.
Very lumpy. If a tax bill arrives in Q3 instead of Q2, the REIT pays it and bills the tenant for the recovery. The economic reality is neutral. The tenant covers the cost, but on a strict quarterly reporting basis, it creates a temporary vacuum in the recognized recovery revenue.
And that vacuum dragged them down.
Yeah, that timing vacuum dragged Curbline's same property NOI down by 2.6%. The revenue isn't lost. It is simply deferred to a future quarter's income statement.
And the second anomaly was a $370,000 expense related to storm damage at a single property in North Carolina, right?
Correct.
Because Curbline's same property pool is relatively small right now. It only includes the specific assets they've held for over 12 months since the spinoff. A single $370,000 repair bill has a mathematically disproportionate impact on the overall percentage.
It skewed the numbers heavily.
Yeah, that storm damage acted as an additional 100 basis point drag.
So if you normalize the data and strip out the delayed tax recoveries and the isolated active nature in North Carolina, the pro forma same property NOI growth is actually 3.1%.
Oh, wow. Okay, a 3.1% organic growth rate on the core portfolio is incredibly healthy.
It is.
It proves the existing real estate is performing, which validates their decision to spend $374 million buying more of it in Q2.
Exactly.
But that brings us to the execution risk. Buying nearly $400 million of off-market real estate in 90 days is not a small feat.
Not at all.
You don't just log onto a commercial Zillow and click add to cart.
I wish it were that easy.
They are hunting for properties built in the 1970s and 80s by local developers. To sustain this velocity, they have built a 26-person acquisition team.
Which is huge. A 26-person team dedicated entirely to acquisitions is an institutional army.
Really?
Oh, yeah. In the commercial real estate ecosystem, most mid-cap REITs might have a handful of acquisition officers who rely heavily on external brokers to bring them deals.
So they outsource it.
Mostly, yeah. But Curbline is operating more like a private equity direct sourcing machine. They are capitalizing on a massive, slow-moving macroeconomic wave, which is generational wealth transfer.
Let's look at the profile of the seller here, because it explains why Curbline has such a dominant first-mover advantage.
It really does.
The person selling these properties is usually a local entrepreneur, right? Like a successful doctor or a regional business owner who bought a half acre on a busy suburban intersection back in 1985.
Exactly.
They built a simple concrete block with 4 storefronts, leased it to a local insurance agent, a nail salon, and a pizza shop. And they've collected a steady yield for decades.
It was a great retirement plan.
But now, that original developer is in their late 70s or 80s. They are looking at estate planning.
Estate planning and liquidity. The heirs to these properties, often the children of the original developers, are frequently professionals living in different states.
They don't want to be landlords.
No. They have no interest in flying across the country to negotiate a 5-year lease renewal with a dry cleaner or managing a roof replacement capital expenditure. They want the asset liquidated.
So they want out.
Yes. But historically, the exit options for these small-scale sellers were pretty limited.
What were their options?
Well, they could sell to another local investor, which often involves a lengthy, painful process of the buyer trying to secure a mortgage from a regional bank. And that process is highly vulnerable to interest rate shocks and lending standard tightening.
Or they could try to do a 1031 exchange.
Right. Sure, but that just defers the management headache into a new property.
So what Curbline offers is immediate institutional liquidity.
Exactly.
They are doing direct outreach, cold calling wealth advisors, contacting regional accounting firms, literally driving up and down vehicular corridors looking for these specific assets.
It's shoe leather acquisition.
And because Curbline is sitting on a mountain of cash, they can offer a seller a clean, all-cash close in 30 days without a financing contingency.
That certainty of execution is incredibly valuable to an estate looking to liquidate. It completely circumvents the traditional brokerage market.
It's smart.
But the operational risk here, which is what you have to underwrite when a company is scaling this aggressively, is how they diligence hundreds of millions of dollars of aging real estate so quickly.
Yeah, that's a lot of risk to take on fast.
You are buying 40-year-old concrete boxes. You have to conduct phase 1 environmental site assessments on every single property.
Especially considering the tenant mix. I mean, if one of those storefronts housed a dry cleaner in the 1990s, there could be perchloroethylene contamination in the soil, right?
Exactly. Or if it was an old auto body shop, there could be oil seepage. Environmental remediation can instantly wipe out the yield on a small strip mall.
So they have to be careful.
Very.
Yeah.
The underwriting process has to be industrial in its efficiency. They have to assess the environmental risks, perform structural engineering reports on the roofs and parking lot grading, and audit decades of potentially sloppy lease documentation written by local attorneys.
And the fact that they successfully closed $374 million in a single quarter suggests that their 26-person team has standardized this diligence pipeline to a remarkable degree.
It's a well-oiled machine.
And the economics of what they are buying are heavily weighted toward capital efficiency.
That's the secret sauce.
The CapEx, or capital expenditures, is running at roughly 8% of their net operating income on a trailing 12-month basis.
Which is tiny.
Yeah, If you compare that to a traditional mall REIT, the difference is staggering. If a massive department store anchor vacates a traditional mall, the landlord is looking at tens of millions of dollars in capex to demolish that box, re-demise the space, update the HVAC, and build out custom storefronts for new, smaller tenants.
Right. It is a wildly capital-intensive business just to maintain the existing revenue stream.
But with Curbline,
The architecture of a Curbline property inherently suppresses capex. CEO David Lukes frequently refers to them as simple, flexible buildings.
because they're basically just boxes.
It is fundamentally a rectangular shell with a glass front. If a local tenant vacates, preparing the space for a national quick service restaurant or a medical clinic requires minimal structural reconfiguration.
So you aren't rebuilding the whole thing.
No, not at all. That incredibly low 8% capex burden is the primary driver of their returns. They are targeting unlevered internal rates of return, or IRRs, of approximately 8%.
And because they don't have to constantly sink cash back into the physical structure, that 8% yield is pure distributable cash flow.
Exactly.
Here's where it gets really interesting, though.
Okay, let's hear it.
The composition of that cash flow brings up a fascinating structural shift in the retail landscape. Curbline noted that their current tenant mix is 70% national brands and 30% local tenants.
Yep.
During the Q&A portion of the earnings call, an analyst brought up a question about the underlying appeal of these centers. Doesn't replacing local mom-and-pop shops with national corporate chains strip the pizzazz or unique draw from these centers?
It's a fair question from a traditional retail mindset.
Right. If a center is just a Starbucks, a Chipotle, and an AT&T store, it is completely homogenized. You can find that exact lineup on any highway in America. Why would a consumer choose to visit a Curbline property over a competitor's if the tenant mix is identical?
It's a question rooted in the old lifestyle center philosophy, where unique curation was required to drive foot traffic. But it misinterprets consumer psychology in the convenience sector.
Oh, so?
When a consumer pulls into a sub-7-minute unanchored strip mall, they are not looking for discovery, charm, or atmosphere. They are seeking predictable utility.
They just want to get in and get out.
Exactly. They want the guaranteed standardization of a national brand.
They don't want an artisanal coffee experience.
Yeah.
They want their mobile order latte handed to them in 45 seconds.
Yes. But beyond consumer preference, the shift toward national tenants is being driven by raw corporate profitability.
The margin.
Over the last 5 years, national chains have conducted rigorous analyses of their store-level economics, and they have discovered that they generate significantly higher four-wall EBITDA in unanchored convenience locations than they do in enclosed malls or massive grocery-anchored power centers.
Just to unpack the mechanics of that four-wall EBITDA advantage, if a national quick-service restaurant operates inside a traditional mall, they are burdened by the mall's restrictive operating hours, right?
Yes, and limited accessibility for delivery drivers.
Right. And high common area maintenance fees for interior concourses they don't even use, and a reliance on the mall's organic foot traffic.
Exactly. But if they move to a curb-line strip mall on a primary highway, their base rent per square foot might actually be comparable, but their total operating costs plummet.
Because they have direct exterior access.
Direct access, dedicated parking for curbside pickup, the potential for a drive-through, and visibility to 40,000 cars driving by daily.
The margin expansion at the individual store level is so profound that these national brands are fiercely competing for limited unanchored space.
And keep in mind, supply is virtually fixed. Developers are not building new 10,000 square foot strip malls because land acquisition costs, construction materials, and zoning hurdles make the math unviable for new ground-up development.
Which gives Curbline absolute pricing power.
Completely.
When supply is stagnant and national corporate demand is surging, the landlord commands the economics. And we see that immediately in their leasing metrics.
The leasing numbers were phenomenal.
Occupancy is at a record 94.3%, which is the highest since their formation. The leased rate, which includes signed contracts where the tenant hasn't yet moved in, is 96.5%.
Yep.
But the metric that proves the leverage Curbline holds is the cash leasing spreads.
Oh, this is the best part.
They are signing new leases at a 20.2% premium over the previous tenant's rent.
That's massive.
Even on renewals, where a tenant chooses to stay and sign a new contract, the spread is 7.4%. A national brand is looking at a 20% rent hike and happily signing the contract because the four-wall profitability still makes it their most lucrative location.
And that institutional demand acts as a massive credit enhancement for Curbline's portfolio.
Because national brands don't default as often.
Right. While they maintain a 30% exposure to local tenants who often provide necessary neighborhood services and are underwritten through strict credit checks, migrating the portfolio toward national corporate credit effectively turns the leases into highly reliable bond-like instruments.
The strategy is brilliant in its simplicity. Target the fragmented, aging supply of convenience real estate. Deploy a massive acquisition team to buy it off-market. Keep capital expenditures near zero. And leverage the surging demand from national brands to drive 20% rent growth.
It's a great formula.
But execution at this scale requires a flawless capital structure. You can have the best acquisition pipeline in the world, but if you fund it with the wrong type of capital, you destroy shareholder value.
You'll sink the whole ship.
This brings us to their management guidance and, frankly, the most impressive aspect of this entire earnings call: the balance sheet.
How they are funding this $1 billion annual investment target is a masterclass in risk management and capital allocation, especially given the macroeconomic environment of 2026.
Let's look at the guidance first. They raised their full-year investment target from $850 million to a clean $1 billion.
Big jump.
Consequently, they bumped their OFO guidance to a range of $1.24 to $1.26 per share.
Which is huge.
At the midpoint, that represents a 17% growth rate. In the REIT sector, where companies are traditionally engineered for slow single-digit growth and dividend yield, a 17% bottom-line expansion is practically a tech stock multiple.
It really is, and a massive component of that future growth is already contractually guaranteed through their S&O pipeline.
Right, the signed not opened pipeline.
The S&O pipeline is a critical forward-looking indicator for retail REITs. It represents the gap between leasing success and revenue realization.
Okay, so they've signed the lease but aren't getting paid yet.
Exactly. Curbline reported an S&O pipeline of $7.6 million in annualized base rent. These are fully executed leases where the tenant is legally bound to the space, but the rent hasn't commenced yet because of physical build-outs, permitting delays, or waiting for a prior tenant's lease to officially expire.
That $7.6 million equates to roughly 220 basis points of total portfolio rent just sitting in the waiting room.
Just waiting to turn into cash flow.
And management emphasized that the commencement of these leases is heavily front-loaded. 90% of that $7.6 million is scheduled to come online and start paying cash rent by March 31st, 2027.
So we are looking at a severe earnings acceleration heading into the fourth quarter of this year and the first quarter of next.
But the real question is how they are paying for the $500 million in acquisitions they still need to close this year to hit their target. Let's talk about liquidity and leverage.
Okay.
As of June 30, Curbline has $850.9 million in available liquidity. Now, they are holding $850 million in liquid ammo, but only have $500 million left to buy this year. Are they sitting on too much cash?
What's fascinating here is how that liquidity pool is constructed. It's built in a very specific way to insulate them from market volatility.
How so?
Well, they hold $154.7 million in cash on the balance sheet, but the vast majority of their buying power, $696.2 million, is held in unsettled forward equity sales.
Forward equity. I love this mechanism. Let's highlight this in plain language.
Go for it.
Forward equity is perhaps the most elegant financial derivative available to a publicly traded real estate company. To break down the mechanics, forward equity is like selling shares today but getting the cash later.
Exactly.
It's like locking in the price of gas today for a cross-country road trip you are taking in 6 months without having to actually pay for the fuel or pump it into your tank until the day you leave.
That is a perfect analogy. It solves the dual threats of equity issuance, cash drag, and market volatility.
Break down the cash drag.
If a REIT needs to fund a massive acquisition pipeline, they could issue $700 million of new stock today and put the cash in the bank. But that creates severe cash drag.
Because it's just sitting there.
Right. You have expanded your share count, diluting your current shareholders, but that capital is sitting in a low-yield checking account instead of generating 8% property returns. Your earnings per share plummet in the interim.
So they don't want that. But conversely, if you wait to issue the stock until the exact week you need to close an acquisition, you are entirely at the mercy of the stock market.
Exactly. If the broader market experiences a severe correction, or if a macro event temporarily tanks your stock price, your cost of capital skyrockets, you would have to issue significantly more shares to raise the same amount of money, permanently destroying shareholder value just to close the deal.
The forward equity agreement neutralizes both risks.
It does. Curbline works with investment banks to sell shares at a known fixed price based on today's favorable valuation. The banks hedge the transaction and the price is locked. But Curbline does not actually issue the shares, dilute their equity base, or take possession of the cash until they formally settle the contract.
They just draw it down when they need it?
Right. They draw down that $696 million in tranches, matching the exact dollar amount of the equity issuance to the exact closing date of an acquisition.
There is zero cash drag, and their cost of capital is completely immunized against future stock market volatility. So they have guaranteed funding for their remaining $500 million pipeline at low 6% cap rates without needing to borrow a dime at today's rates.
And that brings us to the other side of the capital structure, their debt. Curbline's leverage ratio, their total debt relative to the value of their assets, is sitting at approximately 20%.
Wow. In the commercial real estate industry, operating at 20% leverage is almost unheard of. Most peers operate in the 35% to 50% range.
And in the current interest rate environment, that low leverage is the ultimate competitive moat. Look at the broader commercial real estate market in 2026. The industry is facing a massive wall of debt maturity.
Because of the rate hikes.
Exactly. Operators who bought properties 5 years ago using 60% leverage at a 3% interest rate are now being forced to refinance that debt at 6% or 7%.
If you are borrowing at 7% to hold an asset that generates a 6% capitalization rate, you are experiencing negative leverage. You are bleeding cash every month just to service the debt.
The high cost of debt has paralyzed traditional real estate buyers. Institutional funds and regional syndicators who rely on heavy leverage to juice their returns simply cannot make the math work right now.
They are sidelined.
They are completely sidelined. Curbline, operating with minimal debt and nearly $1 billion in guaranteed forward equity, is stepping into a market completely devoid of highly leveraged competitors.
They are acquiring unanchored assets at low 6% cap rates, funded entirely by their clean equity, generating unlevered 8% returns without needing to ask a bank for permission.
They have weaponized their balance sheet. That excess liquidity isn't an inefficiency. It is a fortress that allows them to dictate terms to sellers who have no other viable exit options.
And there is one final piece of management guidance that ties this entire growth story together, and it relates to their overhead. Scaling an asset base from $0 to $1 billion usually requires a massive corresponding increase in corporate infrastructure.
Usually, yes.
But Curbline forecasted their general and administrative overhead, their G&A, at a highly controlled $32 million for the full year.
The efficiency of that G&A load is rooted in their history. Because Curbline was spun out of site centers, they didn't have to build an enterprise-level corporate infrastructure from scratch.
I see.
Included in that $32 million is a $1.2 million quarterly fee paid back to site centers under a shared services agreement.
Because when you spin off a REIT, you don't magically conjure an HR department, a sophisticated IT network, and a seasoned corporate accounting team on day one.
Right, so Curbline pays site centers to handle the back office administrative heavy lifting. An analyst actually pointed out that site centers had a window to terminate this agreement by June 30th, and they allowed the window to pass.
Meaning the agreement will run its full term through October 2027.
Yes. But CFO Connor Fennerty addressed the inevitable expiration of this contract. He clarified that when Curbline eventually internalizes these functions, the cost to hire their own personnel will effectively mirror the fees they are currently paying site centers.
So the $32 million G&A run rate is effectively stabilized.
Correct.
Which creates massive operating leverage. If your corporate overhead is fixed at $32 million, every time you buy a new $50 million strip mall, the rental revenue drops almost entirely to the bottom line.
The administrative infrastructure is already built to handle a much larger portfolio. It is the definition of scaling efficiently.
Okay, so we have waded through the mechanics of gap depreciation, the timing mismatches of triple net lease recoveries, the macro tailwinds of generational wealth transfer, the store-level economics of national tenant four-wall EBITDA, and the elegant risk management of forward equity derivatives.
We covered a lot of ground.
So what does this all mean? We need to distill this into an actionable verdict. Based on the Q2 2026 earnings call, are we looking at a bullish or bearish signal for Curbline Properties?
From a structural, operational, and balance sheet perspective, this is an incredibly strong bullish signal.
I agree completely.
For a retail investor evaluating the REIT space, finding a company that offers legitimate, insulated growth is exceptionally rare. Curbline is generating 17% FFO growth in a sector normally satisfied with low single digits.
Yeah.
They have identified a highly fragmented, overlooked asset class, built the operational machinery to aggregate it at scale, and funded it with a balance sheet that is completely immune to the current interest rate chaos paralyzing their peers.
I am fully aligned with that verdict. It is a rare, definitive buy signal. If you are looking for a growth-oriented real estate allocation, Curbline has built a near-perfect vehicle.
They really have.
They have a $7.6 million S&O pipeline guaranteeing near-term revenue acceleration. They have 20% lease spreads demonstrating absolute pricing power over national corporate tenants. They are sitting on $850 million of liquid ammo, ready to capitalize on distressed or retiring sellers.
And they aren't trying to reinvent the wheel.
No. They aren't trying to reinvent retail or build the mall of the future. They are simply buying the mundane, highly profitable concrete boxes where the modern consumer actually spends their time and money. It is a boring business model executed with legal financial precision.
The simplicity is their greatest asset. But to look beyond the immediate quarter, there is a fundamental risk profile that investors must monitor over the long term.
What's the catch?
Right now, Curbline possesses a virtual monopoly on the institutional aggregation of unanchored convenience retail. Management noted that despite their massive acquisition volume, they still own less than 1%, roughly 60 basis points of the total U.S. inventory of these assets.
Wow. They're dominating the sandbox, but the sandbox is unimaginably vast.
Yes, the threat is not the supply of real estate. The threat is the eventual influx of institutional capital.
The big guys.
Right. Curbline is publicly proving that you can aggregate these assets at low 6% cap rates, run them with 8% capex burdens, and generate massive cash flow. The national tenants have already realized the superior four-wall EBITDA of these locations.
So it's only a matter of time before the massive private equity funds, the Blackstones and Starwoods of the world, recognize the arbitrage.
Exactly. If a wall of private equity capital decides they want to allocate $10 billion into the unanchored convenience space, they will flood the market.
That influx of buyers would spark intense bidding wars for these mom-and-pop properties, driving acquisition prices up and compressing cap rates.
Curbline's ability to buy at a 6% yield could vanish if private equity is willing to buy at a 5% yield just to deploy capital.
That makes a lot of sense.
While institutional crowding would skyrocket the net asset value of Curbline's existing portfolio, it would fundamentally impair their ability to generate those juicy 8% unlevered returns on future acquisitions.
Because they'd be overpaying.
Right. How Curbline navigates the inevitable institutionalization of their niche and whether they can maintain their direct sourcing advantage when the giants enter the space will dictate their long-term legacy.
It is the ultimate paradox of real estate. Exceptional success inevitably breeds fierce competition.
It always does.
But for now, while the rest of the market is frozen by high interest rates and mourning the death of the experiential mall, Curbline is aggressively buying up the intersections of everyday life. The machinery is working exactly as designed.
It's an impressive quarter, for sure.
Thank you for joining us on this deep dive into Curbline's Q2 earnings. Keep analyzing the mechanics behind the numbers, watch how the macro environment shifts, and we will catch you on the next one.